All right, we're about 2 minutes away from getting things started. Looks like we've already got some people on board waiting patiently for us. So feel free to crack open that chat and check in with us so I can give you a little shout out before we start getting into things this week. There we go. We got a couple in the Twitch chat. We got Hypers and more for. How we doing tonight? How we doing? There's S Kotha in the Twitch chat. JM cracked the chat open as well. Let's go. Good to see everyone coming back again for another weekly discussion. Cash Money, how we doing? We are just over a minute away from getting it going. And there's Jules, the queen bee, checking in with her emoji. Here we go. We've got a Nonth in the YouTube chat. We've got 20 seconds until we get the show underway. Sierra in the Twitch chat. How we doing? And Sierra potentially the leader in the clubhouse right now in our Discord server of posting pictures that make me incredibly jealous of where she is at all times. All right, that is going to be it for our timer. I'm going to get rid of the notification. And we are going to jump back into it for another week of our weekly options trade ideas. Thank you again for everyone who has joined us tonight. And let's just jump right into it, right? We had a really, really good week last week. There was a 2.05% return. The S&P 500 dropped 0.91%. So again, the game we're trying to play here is to outperform the S&P 500. So anytime that we can, make money, period, when the market is red, nevertheless pull a 2.05% return, we are going to be thrilled. If we pop over to the year-to-date summary tab in this worksheet, we're going to see that we're really starting to get some further separation. I mean, we've really been pulling away from the S&P 500 for the back half of this year so far, but we're really on a weekly basis getting further and further ahead. As you can see, we outperformed by 2.95% this week, 2.37% last week, 1.4, 2.2, 0.12. And the last time we underperformed the market, I think you need to go, there you go, on a weekly basis. You have to go back to the week of July 19th for the last time that we underperformed the market. And during that week, we still made, $2,200. So even though that was technically a loss in the scheme of what we're trying to do here, we still made money. So we are always happy if that's the quote unquote risk that we're taking on with our strategy. But back to what we did this last week, again, really, really solid performance in the face of a market downturn. We've talked about the strategy that we're trying to employ where we're targeting more of these IV reversion type plays. One, because they have some really nice value from an option premium perspective. And two, they're kind of disconnected from the performance of the overall market. And that's best demonstrated by, again, taking a look at our performance last week in comparison to what the S&P 500 did. Because, we've got things like RKLY, OPAD was one, JOBY. These are all trades where there is this huge spike in implied volatility. We sold options during that spike in implied volatility. The premium eventually either went back down or we were able to hold these with enough of a cushion until expiry to hit max profit. But the point is, even though the market was rapidly moving down last week, these types of trades that we were entering into were relatively unaffected. And in a time where people are getting a little bit uneasy about the performance of the market, I think this mid to late September date is a time period a lot of people had marked off mentally about when they think the market might start to take a tumble. September historically is a red month in the market. We've already seen that as, 2 weeks ago. It dropped 1.7%, basically it dropped 0.91%. And if we sneak peek at futures, it's already down 0.32%. as we head into the overnight futures for getting things going Monday morning. So the market is not looking great overall, but with these strategies that we've put into play, we're able to work around that and not be too much at risk if there is a severe pullback right here. And the other thing outside of those IV reversion type strategies that we have been using so successfully is just that concept of keeping a lot of buying power on the sidelines, right? If you're going to enter into a trade, don't use all of the potential collateral up front. Keep some on the side in case it moves against you, and then you could deploy some more capital to move that basis down, essentially doubling down, averaging down into a trade, and you'll give yourself a much higher percent chance of pulling a profit. And that's what we did here. We've started building out these margin requirements so you could see what we've got in play. I think heading into this week, we're only using 34% of our buying power. So we have about 66% of our buying power free as we head into Monday. And if this futures number gets redder and redder overnight and things are looking terrible Monday morning, that's not going to be the worst thing in the world for us, because we're going to have some really nice entry opportunities and we're going to have plenty of buying power free to do that. And for a quick aside to potentially anticipate a comment that I'm sure some of you are thinking is, hey, we use leverage. We could see that we're only using 34% of our buying power, but if we're fully assigned, using just over 100%, is that really a place that you want to be? And in general, I would say, no on paper, but if you actually take a look at the context of what these things are that are bumping up the buying power, it really just is that Rocket Lab January 2022 7.5 strike put and the UWMC December 7.5 strike put. Neither of those are terribly high risk, so we're not really worried about what those are doing, right? Because if we eliminated these, we would be down to, come on, only 42% of our account being assigned. So, it's important not just to take these numbers at face value when you're evaluating how safe your position sizing is, but also to take a look at the context of what those positions actually represent. So I think we're in a very good place with buying power. I'm very happy with where we are, especially up to this point of the year. But I guess top to bottom, we've talked about UWMC all the time. As long as that one stays above 650, 640-ish, we're going to make money on the trade overall, and that max profit point is going to be at 750. It had a decent back end of the week. We could pull the chart here. It did come back toward the end of the week, but again, one of those, we're not terribly worried about it until mid-December. So it's got all of, October, November, December. We've got 3 months until these things expire. So, while it's nice to have this pop back up at some point, as long as it gets back to 7.5 by December, we're going to be okay. It's a really nice base. If it does, take a turn for the worse, get back down to this 640, 630-ish level, that's our break-even price for the overall trade. So even if it does take a downturn and get back down there, we're going to have just tied up money with no return, which, isn't the best thing in the world, but when a stock moves this sharply against you, that kind of result on a trade definitely isn't the worst thing in the world. And that's why we're a fan of, diversification in stocks that you're trading, but also diversification in strategies that you're deploying, right? You'll see up here, we have 2 longer dated puts. And like we mentioned, these don't tie up a ton of buying power. So we like letting them, if you're using margin like we are, letting those sit in the back of the account, sell something with high IV for a lot of premium at a relatively unattainable strike, like what we did with Rocket Lab, where we sold 7.5 strike puts. I think Rocket Lab is at 16-ish. RKLB at 50. There you go, 1541. So our max profit point on Rocket Lab, you have to zoom out on the chart to get down to 750 right here. But we were able to do this because, as you can see from this blue line down here, there's this spike in implied volatility. And we sold something out in January, and that allowed us to get just an insane amount of premium on these 7.5 strike puts. So we're going to keep letting those ride day after day, week after week, and eventually, hopefully, exit for a nice profit at some point. But that's the idea behind those. We're not terribly worried about those on a week-to-week basis, so it's nice to have some peace of mind and stability in the account when we have these leading things off. ZEV, RKLY, LIDR, these are all IV reversion type examples. We can take a look at one really quickly, right? If we look at LIDAR, LIDR, this was one where it jumped up to 9, I think, and we said, okay, this is, I guess as far as the timeline, it was trading around $7 a share on Thursday morning. It jumped up to 8, and this big spike right here, what do we see, right? We see this big spike in implied volatility. So we said, hey, let's sell what we perceive to be a relatively unattainable strike price. So we sold a 7.5 strike put that expired Friday afternoon. And you might say, hey, the thing was trading at $7 that morning. Is that really that unattainable? And you would be correct, but when something's shooting up like this, shout out to Cole Evans for the follow right there. But when something's shooting up like this, you want to ride the momentum a little bit. It's already up here at 8, so it would have had to drop all the way back down. And even when we looked at that 7.5 strike for a trading period that was roughly a day and a half, 7.5 seemed like a relatively safe strike. And again, when we enter into trades like this, we always want to think not just about the strike we're getting right now in that expiry, but in the event that it does drop back down and we get assigned, what kind of premium we can get going out to step 2 of the trade. So, if we did sell the 7.5 strike puts like we did for 15 cents of premium, we know that that would have stuck us with a 7.35 cost basis. And then from there, we took a look at these October calls, which had a ton of premium, right? Even if you wanted to sell pretty much at the money for 7.50, you're getting over $1 for that. So you would have taken that 6.30 break even, or excuse me, the 7.30 break even price, taken over $1 off that, and we could have been in a position where we had a break even of about $5 on those shares. So while 7.5 might not have seemed like too big of a cushion for what we saw on the chart right here, we had confidence that if things did turn against us, we had to take assignment and then roll into covered calls. It was step 2 of that trade where we were going to have a much better cost basis. So that's what we did with that. We were able to pick up a quick $100 off of that one. OPAT, very similar story, right? We knew you're relatively familiar with the company, right? It's in the same vein as this Zillow, Redfin. It's these digital buyers of homes, which I personally is an industry I'm very interested in. So anytime I see a company in the news or a company that's offering good premium in the industry, I tend to jump on it. So OPAD was a great example of that. It was a former SPAC, and that's something that these all have in common. We can go back into that in just a second. But the idea is, hey, you look at the 180-day chart right here. This is what your chart for a SPAC is going to look like. And for those of you who have followed along with us, this is probably going to be a lot of things that you've already heard me already heard me say so far. But, you look at this chart, you have that net asset value of $10 a share. It's not going to drop below that, before the merger. But you have the merger, that idea kind of goes out the window. If we go to the 20-day right here, you can get a little bit better of an insight. It's up to 24 the morning of the merger, just some wild volatility. And then, bottomed out at 820. But it came into our life, I guess, back when it spiked back up to this 9-ish level, because as you can see right here, there was a big spike in implied volatility, which means that there was a big spike in option premium. And the options that we were able to sell on that were 7.5. And we had that plotted out right here, right, with these 2 red lines indicating the top line is our max profit point and the bottom line is our break-even price. So when we plot these out, it looks pretty nice in the context of the chart. One of those things where the premium was good. It's on a company in an industry that I like. So even if we were assigned at 750, I wouldn't have been too mad about it. And the best part about those 750 puts is that for October, when we sold those, they were trading for 83 cents of premium. And this is another area that I want to touch on because I think it might be a helpful point to point out, is that, it did have 9/17 expiries, but sometimes when you see big spikes in implied volatility like this, there's not going to be a ton of premium on the 7.5 for the nearest expiry, which was going to be September 17th in this case. So what we did was we went out to October to get, I think, for some context, I think the 7.5 strike puts for September were worth maybe 15 or 20 cents a piece, similar to what we saw with LIDR. But, we said 15, 20 cents a piece. I don't think it's a ton of value. I like the stock. I'm willing to go another month out to October 15th, and I was able to get 83 cents of premium as opposed to, 15 or 20 cents of premium. And the great part, we talk about this spike in implied volatility. When it falls back down to earth, it really starts to hit these options hard. And, it did go back up this implied volatility, but, it went up because the price of the stock went up. And as the price of the stock goes up, the chance that it goes back down to 750 significantly decreases. So all of those factors came together to, in this short period of time right here, drop these October 7.5 strike puts back down to 40 cents a piece. Meaning, originally we said, hey, we think that we're going to be able to sell these 7.5 September 17th puts for 15 or 20 cents. Since we actually went out to October, the decrease in premium that you see right here of 43 cents is basically double the return of what we would have sold for September anyways. So that's something to keep in mind, right? We always do, like, not always, but like there are exceptions like what we're talking about right now. But in general, we like to sell the most, the nearest term expiry because that has the quickest data decay. You're going to get your returns faster on that on a percent return based off max profit basis. But when you're thinking about overall premium that you're getting, right, you could see the impact of going a month out or so, or going to the next expiry, biting off a little bit more premium and hoping that the dive in implied volatility and drop off in premium kills more premium on those longer term options than it would have on the shorter term. And that's exactly what we saw with October. So an interesting little quirk there in the vein of these IV reversion type trades that we see right here. And to the point I was alluding to earlier is a lot of these are former SPACs, right? FFIE, former SPAC, ZEV, RKLY, LIDR, OPAD, JOBY, and that's it. I think those are all former SPACs, meaning special purpose acquisition company. What do I mean by that? If we go out to the 180-day chart, this is exactly what you see, right? It's this holding company full of cash. They're going to use that cash to buy a decent stake in a company that they're going to take public. And it's just an easier way for companies to get access to public funding and avoid the hoops you have to jump through for a typical IPO process. Now, the downside of that is sometimes the companies that they're taking public aren't going to be the greatest companies in the world, but the potential upside there is, right, you can get this investment at 10, and if the stock shoots up, there's some decent upside value there, and it worked out that way for a little bit of time. Shout out to Aroldis for the follow right there. Appreciate that. Love hearing that notification pop up. But, the idea is you were able to get into the ground floor at 10, and for the longest time, like back in fall, winter of last year, there's this big SPAC boom where everyone was jumping into these things at $10 a share because theoretically they couldn't go too much lower before the actual merger, and then they would merge and people would head for the hills and jump out. But what we have now is a situation where I think a lot of people are starting to see past that. We've seen some really big drop-offs post-merger. I mean, a couple good examples are if you look at RMO, this is one that was a SPAC. We go back out to the one-year chart. You're going to see that, price floor shot up on hype, and now it's back down about $5 a share. LOTZ is another example of one where you had that price floor around 10, went up a little bit, and is now down below $4 a share. So can these go poorly? The answer is absolutely. But one thing to keep in mind is the amount of time it took for these to drop as much as they did, right? With LOTZ, they essentially were a car rental type company and had their biggest supplier of cars cut off for them due to supply chain constraints recently. And, basically losing an enormous chunk of your revenue source dropped this thing down to $4 a share. But how long did this take, right? From when it initially dropped back below 10 for the first time in February to now is about 7 months. So we think, something like LOTZ, something like RMO, even something like RIDE, a company where they essentially said, hey, I don't think we have enough cash to continue our business. These are companies that I like to picture as worst case scenario for SPACs, right? And even this one, a company that said it did not have enough cash to continue operations potentially, is trading at 7 a share. So that can just speak to the fact that even if some of these that we are playing are bad companies, they have some bad news come out, something like that occurs, what is the actual downside in that opinion? Because I think Lordstown in particular had one of the worst possible pieces of PR I think any company could have, which is essentially implying that you're going to have to shut your doors one day, and they're still only trading at 7 apiece. And if you look at all of these former SPACs that we've been getting into that carried so much premium these past few weeks, look at these break-even prices we had. FFIE break-even price of roughly $7.79. RKLY break-even price of $4.95 there. Break-even price of $7.37 there. Break-even price of $7.27 there. LIDR break-even price $7.35. OPAD break-even price of $6.77, something like that. I think my math's slightly off there. But point being, all these break-even prices that we had for what theoretically could be thought of as risky trades are all in this range of, potential worst case scenario price action for a SPAC. And again, the time frame that we had on these trades was 1, 2, 3 weeks, whereas the amount of time it took for these SPACs to actually realize that quote unquote worst case scenario, like for Lordstown, it first dipped back down below 10 in April and bottomed out in August. So that even took 4 months. That example we took a look at with LOTZ took 7 months. So even if something did go poorly, it would take what we could estimate based off some of the stocks we've seen between 4 and 7 months to get down to these break-even prices. So anytime we have the opportunity to get into a former SPAC with a break-even price that's in that worst case scenario range in a short time period, That's something I'm going to jump all over. And we could look ahead to what we're doing next week. TMC is another great example. We've got some serious premiums on a former SPAC. We did half and half because I couldn't quite figure out which one I wanted to do. But between the 5 and the 6. But individually, these trades have a break even of what? 479 and 555, which if you look at, worst case scenario, these all fall right around here. And our expiry on these options is less than a month away now. So it's going to take a long time potentially for TMC to get down there if something did warrant that kind of a drop. And if we take a look at TMC, right, you see this volatility post-merger. But when you zoom in, it's still a long way to go to get back down to those 6 and 5 max profit points that we have on that trade setup. And our buddy implied volatility has slowly been running up here. If at any point this thing starts leveling out back around 10 and the implied volatility drops back down to what it was, even just a couple of weeks ago, the premium on these 5 and 6 strike puts is going to be gone. And we're going to be looking at hopefully max profit here on these, which is going to be about $700 on that trade. One that doesn't tie up a ton of collateral at all. So that's another reason we love that one. But that's kind of, instead of going individually line by line, because the theme is going to be the same on a lot of these, that is what happened with RKLY, ZEV, OPAD, LIDR, JOBY. It's the same idea for every single one of those trades. And if you take a look at all those trades, they made us some profit, right? And we had another, what I would call a perfect week, because even though you see Ziop lost $20, because on a week-to-week basis it lost 20, when we opened that trade last week it made 50, so it nets out to a $30 gain. But all in all, these new trades that we alerted made us $2,260, and these were all trades that we did not have going into the week. These are things that we alerted, opened up new positions for this week, which is why following along with us on a day-to-day basis is so important in the Discord server we've got, which is the perfect time to switch over into the little aside that I have before we get into what I'm looking at for the upcoming week, which is what I'm sure a lot of you are a lot more interested to hear. So quick piece of self-promo here is going to be our Discord server. If we drag this over here, this is our Discord server. We've got premium channels right here where we alert every single one of our trades as we make them. You could pretty much cross-check every single trade we have in here with every single trade that we have in our profit tracking spreadsheet year to date. So we've got a pretty good paper trail gun right there. But again, you'll basically get these alerts sent to your phone if you sign up for HT Premium, which you can do by going to our website, hourglass-trader.com. Hopefully it loads quickly as I talk right here. Perfect. Click Join HT Premium right there, and hopefully this loads as well. Awesome. You've got two options. It's either going to be $225 a year, which is a 25% discount on a monthly plan on an annual basis, or you could hop on for just $24.99 a month, which accomplishes the goal of, keeping things a little cheaper overall, because that's less than $1 a day for everything that we're offering in here, which is not just the trades, right? We've got a watch list that we keep up with. We have the option scanners that we use to come up with our trade ideas. And then every now and then we'll write up some trade ideas to explain, what we're looking at. Like for this one with RKLB, like we just talked about on the top end of the stream, comes with its own little blog post that you could take a look at if you're curious about some of the methodologies and ideas behind the trades that we're entering into, so you can get a little bit of context to go along with those trades. And, I think the trades alone are super valuable. We've also got a super active chat in here, which, on the weekends gets a little bit off the rails, but during market hours, I myself personally have gotten some great ideas from this as well. So if you are just new to following us or on the fence maybe about getting into HT Premium, I think we've demonstrated the value is definitely there. We made over, like we showed, $2,000 just off what was alerted this week. If you look at what was alerted last week, it's another $2,000 of profit. The week before that, what we alerted pulled about $3,000 of profit. And I think those who have joined can speak to the fact that it's a pretty good return of investment on your part if that's something that you're interested in. You're really serious about using our trading strategies to make some money in the market. So that is where I will cut my spiel off again. Hourglass-trader.com if you want to sign up for HT Premium. There is a 1 week free trial, so you have zero financial commitment, and you can get a feel for if what we're doing is something that you think fits you. And if you want to get a free month, you can use our Webull sign-up link that we have in our Discord server, and you'll get a free month of HT Premium. So that's another way if you don't want to pay that off the bat, that $25 or the annual fee off the bat. That's a good way between that 1 week free trial and the Webull sign-up. to get a free week or a free month to get a feel for it and see if it's something that's for you. But with no further ado, after, let's see, it took me 32 minutes that time to get through the weekly recap. I feel like, I'm trying to do a little bit better every week, but I feel like we end up on that 30 number every single week consistently. But hey, nothing wrong with consistency, I guess. So let's take a look at what we're doing for the upcoming week. And again, like we mentioned, a lot of the time what we're doing is just something that we've rolled over from last week. Like RKLY, that trade idea that we had where we were selling these 917 7.5 strike puts. You take a look out into October, you'll see that the 7.5 strike puts are offering 87 cents a premium. That's something that gets us near around a 663 break-even price. I think that mental math is right. And again, take a look at RKLY's chart. Former SPAC. Let's get it up here if I could learn how to type. There you go, right? I mean, it bottomed out at 681, so the downside is definitely there. Do not get me wrong. But if we zoom out a little bit back to the 180 day, come on. There you go. You're going to see that classic SPAC chart, $10 price floor. We got Jason saying he just subscribed and had the full annual subscription made in his first week. Appreciate the shout out, Jason. And above all else, I'm glad you're having some success. I love to see it because the idea is we could all win together, right? Just because I enter a trade doesn't mean if you entered, you'd be stealing from me. The idea is, we go in on these together, we do our research together, and we make the trades together and just sit back and watch together. And hopefully we can all experience some similar returns. And it seems like, I think as a group, we've been doing a very good job of that lately. But to keep going with Rockley, I don't know why. Yeah, it is Rockley. Okay, perfect. I just, pronounced the way I thought the ticker would be pronounced, so I guess that turned out correct. But with this $10 net asset value, you've got the merger, jumps up to 17, drops down to 681, and then pops back up to 10. That's obviously going to breed some insane implied volatility. You could see from that initial jump up from 7 to 8 or 9, and this jump is caused by the fact that I think there was a rumor Apple would be using their technology in the newest Apple Watch. And so that spiked it up. Right around here, Apple had an event, and they didn't really mention it. It's not like they denied the rumors. They just didn't announce or confirm it. So there's a big red candle down. But again, one of those things where even if things don't go well for a SPAC off the bat, it takes a lot to really drag it down to this $7, $6 level in a short time frame. Because the stocks that really deserve to be down there, they'll get there. Don't get me wrong. And this one might get there. That's definitely something that could potentially happen. But you have to, reconcile the odds of that happening, one, with two, the time frame in which that could potentially happen, which between now and October 15th is a very short time frame for something that's trading at about $9 a share as of post-market trading on Friday. And since I didn't take a sip of my water before we jumped into this, I'm going to need one really quick. I think my throat's getting a little dry. That's a lot better. And some absolutely brutal news out of my kitchen this week is that my refrigerator and freezer still broken. So I'm slumming around with no ice water. I've got some room temperature water, but I've read that's better for me. So we'll see if this helps my performance on the stream. You guys will have to let me know. But taking a look at, Rockley again, we sold these 7.5 strike puts. 87 cents a premium is going to leave us with a 663, I think I said break-even price. If we plot that on the chart here, we can get rid of our old break-even price by removing that drawing. 663, if I select the drawing tools, is going to pop up right here. Close enough. And again, when you look at these things, zoom out, look at your break-even price on the 180-day chart, this kind of cushion looks super, super, super nice. It's at a price that it literally hasn't touched, albeit our break-even price is a little bit higher. Our max profit point is right here. But that's an area where last time it broke down below at the end of August, it shot back up above quickly. And when it dropped back down below or to that level about a week ago, it bounced sharply off of that level. So I'm really happy to be sitting there with the 750 max profit point, especially when you consider the amount of premium that we were able to get us a break-even price down around this level. So that is the idea behind that one. TMC, like we mentioned a second ago, 5, 6 strike puts. We just pulled this one up, but just to look at it again, our break-even price, you have to zoom so far out here because our max profit point is at 6 for the 6 strike puts that we sold and at 5 for the 5 strike puts that we sold. That is just so far away again in the context of 1 month of trading. for what we're set up here with. And is it possible that it comes back down this low? Absolutely, it's possible, because these things wouldn't have premium on them if it were impossible. But the idea is, what is probable, what is likely to happen, and it's very, very likely that this performs better than dropping, 40% over the next 3 or 4 weeks. And again, we take a look at the 180-day chart that we have up here. Implied volatility, our best friend, is starting to rise back up here. So again, one of those things that inevitably, when it goes up, it's going to come back down. And when it comes back down, these 5 and 6 puts are going to lose the premium on them. I think targeted exit, and for a lot of these things, since we did open a lot of October 15th puts, since the opportunity was there, I felt dumb if I did not take it. But the idea here is, the way, I guess the question we get a lot is, when do we exit? Do we want to keep holding on to these things? And the way I think about it is on like a pro rata basis, right? So we know that if we have these expiring on October 15th, we have, if we look at our calendar right here, we have 1, 2, 3, 4 weeks. So at the end of the 4-week period, presumably, if you were going to hit max profit, you would be sitting at 100% of max profit, which means over 4 weeks, if you are making that money on a linear pro rata basis, you're going to be hitting 25% of max profit per week, right? So come this Friday, these trades should be at 25% of max profit. Come next Friday, when you hit October 1st, these should be at 50% of max profit, because we're 2 weeks into that trade, and so forth. But using that information is a good way to figure out if you should stay in a trade or get out of a trade and take that profit early. So if it's this Friday and we see that, implied volatility has dropped back down, the premium has been sucked out of these, and we're sitting at 50, 60% of max profit, to me, that's a no-brainer, because you could take 50 to 60% of max profit in a time frame or on a pro rata basis like we talked about. You really only would have been sitting at 25% of your max profit. So that is the way that I think about that. And again, we can only trade what is in front of us, right? If we see that we have 50 to 60% of max profit, we can close it out and lock that in. There's no guarantee that when we wake up tomorrow that 50 to 60% max profit that we had today is even going to be a profit at all, because things can change in the blink of an eye in the market. So we can only change based off what is in front of us, and the only thing we know is what we're seeing as we look at our account. We don't know what things are going to look like a day from now. We don't know what things are going to look like a month from now, which is why I think we get that token kind of tongue-in-cheek response when people in our Discord server ask, like, hey, what's the market going to do tomorrow? Because my answer is always, if I knew what the market was going to do tomorrow, I would be rich. No one on planet Earth, despite what they may try to convince you, no one has any idea what's going to happen tomorrow in the market, or the next week, or the next month, and so forth. In actuality, everyone is out here guessing, and it's best to do what we're doing, where we guess and give ourselves some really big cushions on the downside in case we're wrong. So that is the idea with what we're doing right there. We've given ourselves some huge cushions here. And again, these are all 10-15. I do like to get weekly expiries. If you take a look at our trade history, we typically hit those weekly expiries, 9/17, 9/10. We had some 9/3s in there when September 3rd was the Friday of expiry. But that's something I'm going to be looking to enter into as the week progresses. However, on Friday afternoon, when we were closing out our current week trades and rolling into what we had right here, just didn't see a lot of opportunity for stocks that were expiring this Friday. There were a couple we saw. FFIE, which was a 9 strike, we sold it for 15 cents, and I think it's down to 5 cents because FFIE dropped down to, or I guess FFIE kind of started running away Friday afternoon before close. Yeah, it ran back up almost near $11 a share. So we're perfectly happy with that. If we look at this, these are back down to, I think, looks like 7.5-ish cents of premium. So what we sold Friday afternoon for the next week is basically trading at 7 cents now. So we basically hit $80 of profit for free on the front end right there. And, Aroldis in the Twitch chat asking us if we had the crystal ball. And I got to be honest, if I had the crystal ball, I think I would be on an island somewhere and not talking to anyone on a stream right now, because money would not be a concern to me. But, with that said, we are where we are. So how you guys doing? Thanks for joining me tonight. And, I think we're far enough in where even if I did live on an island somewhere, I'd still hop on the stream and talk to you guys. You guys are nice. Great people. And let's keep moving with these great people. So again, FFIE was one that we had for a weekly expiry. The other is SDC Smile Direct Club. This one is not like the strongest stock in the world, but sometimes you don't need to play the strongest stocks in the world. The numbers just have to look good. And this is one where, quite frankly, the numbers looked good. If we zoom this thing out to a 20-day chart, you can see there's this recent spike in implied volatility, but that came with the stock going from roughly 480 up to 693. So when we think about what we were able to set up with this trade, is we had a weekly trade, 5.5 strike with 14 cents of premium. That's going to give us a 536 break-even price, which is right around here. And for those of you who follow us, when we do our stock analysis, you may say, hey, HT, a month ago, this thing was, a dollar, not a whole dollar, but like 60, 70 cents below your break-even price. What's the deal with that? Isn't it possible that I could go back down there and to echo what I've, said for pretty much all of these trades? It's definitely possible that that could happen. But let's back this thing out to the 180 day. This thing has dropped a ton, and implied volatility is basically at a 180-day high. So that option premium is going to be beautiful. If this thing ever does, decide to settle, or if it just keeps running back up and gets back to this $7 or $8 level that it was previously trading at before it began its next leg down back in beginning to mid-August. But, as Hypers is saying in the Twitch chat, it's getting pumped on Reddit. People are trying to short squeeze it. And, what we do, quite frankly, I love these short squeezes because what they do is they pump implied volatility into stocks and let us sell things at strikes that are out of the money, get some good premium, and we could pull just really nice, safe weekly returns. There's all these people out there who are, getting into Rockley because you take a look at the chart and it's running and running and running and running and running. If I go back to the 5-day, you're going to see, it ran from $7.50 up to $10, and all these people are going to be trying to get in because the stock's running, it's running, and they're trying to buy calls, and they're not going to be able to time them very well. And let's look at what would happen if you tried to buy an October 10 strike call. Let's take a look at the price action on this one, right? So if you were trying to buy this 10 strike call, if this can pull up, let's get this back on a 5-day. You might have been chasing this whole week, like from September 16th, which was Thursday, which is really when the action started beginning. You could have bought a 10 strike call back when this thing was at 850. The stock, and when you did that, you would have been buying it around 130. The stock ran up from 850 to 10 at one point Friday afternoon, at which you would have bought it at maybe 130, 140, and the most you would have gotten to is 180. So you would have had a pretty big move on a 1.5 day basis from 850 up to 10. And then by the end of the day, as is the case with so many of these little pumps, is there are some very big red candles that are the dumps. So you would have been trading something that you bought at 130. You would have been saying, okay, there's a good move in my favor. I'm at 170. I don't really think I should get rid of this because this isn't that big of a gain, and I think I could keep running. And then boom, in the blink of an eye, 5 minutes pass, and you have a option that was previously worth $1.70 and is now worth 90 cents a piece, and you've lost 40% of your investment. Whereas if you take the option selling approach that we take to these events, you've got the other side of it, right? You don't need to buy calls. We just sell cash secured puts. So if we take a look at the 7.5 strike puts, let's take a look at the price action right there and compare that. And there you have it. On these big downward spikes, or these, I probably should get this on the same time frame, the 5-day, 5-minute. There you have it, right? These things were trading for about $1. The thing's running a little bit. It's getting a little bit crazy. Implied volatility is increasing, so the price of the options probably increased a little bit. But you can get something that you could sell for about 90, 95 cents a piece. And even though there was this huge downwards candle, which we saw on the call side, completely wiped out profit and put you into a pretty big loss position, you could have gotten in on a put selling side by selling something for 90 that is now worth 80 cents a piece, even after this enormous candle, and be making money, as opposed to the call buyer who got a ton of their profits wiped out in about a 5-minute window Friday afternoon before the weekend because they were chasing a squeeze. So that is what is so great about these short squeezes for us, is that they pump all this premium into these put options, which is fantastic because we could sit there as the premium decays, and we could mess around with, from a chart perspective, a break-even or a max profit point down here and a break-even price down here. This thing could run as far up as it wants to, Whereas the call buyers are sweating it out right here for every green and red candle. We can sit back with our 10, 15 expiries knowing that as long as, whatever happens up here happens, but as long as it stays above this red line, we're making max profit. And as long as it stays above this red line, we're not going to lose a single cent on the trade. And that is why I love taking the option selling approach that we've taken to a lot of these short squeeze type plays, because this spike that we see in implied volatility means that there's a ton of option premium that we could sell. SDC, same exact story right there. You're seeing this surge in implied volatility. This thing can run off to 15 for all I care. It can do whatever. I don't care. As long as this thing finishes above this red line, we're going to be a happy camper and not have to stress on every single overnight up or down red or green candle. It's so low stress. It's hands off. Takes 5 seconds to put the trade in, and then you just hang tight and wait. And if you miss a great exit point, guess what? Just wait a little longer, and odds are in a day or two, there's going to be another exit opportunity. So that's what we love so much about this strategy. And that's, again, to talk a little bit about what we have set up for this week. That's why we have so many of these setups. The numbers add up really. I think the last one we can take a look at, or I guess really the last one we haven't talked about too much. I guess we have two, ACIC and RKLY. Let's take a look at we talked about RKLY. I mean JOBY right here. We sold 7.5 strike puts, not quite as much premium, which, I would have preferred a little bit more premium. But to that point, since I didn't like the premium as much as I liked Rockley, I only sold 10 of these as opposed to 25. So another, situation where it's so important to keep position sizing in mind, right? And I think the trade alert that I put out said if this thing gets back up to 70 or 80-ish cents, that's when I'll add more. I'll average up to the 60, 65 cent range overall credit for this trade. But even if it doesn't get back up there and things stays above 750, we're still going to cruise to a $520 profit. And, taking a look at some of these profit numbers is exactly what, gives me some peace of mind knowing about what I can expect to make on a weekly basis, right? So between now and October, like if RKLY, the one that we just looked at, finishes worthless, there you go. That's $2,000 right there. If Joby finishes worthless, and all of these October plays just don't completely fall off the face of the earth, that's $4,000 of profit, which, there's 4 weeks until October 15th, meaning that from these, quote unquote, longer term trades that have October 15 expiries, $4,000 over a 4-week period, we're basically going to be pulling $1,000 a week off of these, which should be pretty low stress, low maintenance trades. So that's why we love them so much. We're going to look for more 924 expiries this week. One quick look at JOBY, because that's the other one we opened. Didn't have as much premium as we liked, but I also think this is going to be a much safer stock overall. I think Cathie Wood has a pretty significant investment in this. This thing's back up to 926. Again, max profit is 750. Our break-even prices are going to be around $7 a share. And as we showed LOTZ, RIDE, RMO, those former SPAC disaster charts, we've got that break-even around 7. I think it would take a lot for this thing to get to 7 in 4 weeks. So happy with the way that's set up. And same deal with ACIC. They underwent their merger last Thursday afternoon, changed ticker to, I think, ARCH. And I think these are down to like 20 cents already just because it didn't completely fall off the face of the earth on Friday when that happened. So we're rolling into this week with this lineup. And again, we only have 34% of our buying power used. We're remaining cautious because, as we can see, futures down 0.42%. That's a decent overnight drop at this point at 9:50 p.m. Eastern right now at the time that we're live streaming this. And again, we have this conversation every single week. Decent looking pullback. Go to the 20-day chart. Give me 1 second if this thing loads. If we go to the 20-day chart here, we'll say, okay, that's a decent looking drop, and we don't need to look at IV anymore. We can take a look at our buddy. Wait for it. RSI, Relative Strength Index. Take a look at, are things overbought? Are they oversold? And we definitely have the indication right now that things are getting oversold on a short-term basis. But I think the best way to take a look at this is a little bit longer term, because while the last month's, gains in the S&P 500 were wiped out, there still is a long way down to go. If we take a look at the 180-day chart, this really isn't much at all. And granted, every time we've gotten into this blue area, indicating that something is oversold as far as RSI is concerned, we've seen a little bit of a bounce. So I wouldn't be surprised if we got some short-term relief here. But the point being is really this is just a blip on the radar, because even on the 180-day, it's comparable to some of these drops. And you might say, hey, this looks similar to here, 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 we could probably expect a rebound soon. But if you look further out to like the 1 year, this is the, this isn't even the COVID drop. And what we have from here to here is about a third of the drop that we had from here to here. And if we zoom out to the 3 year, these red candles really don't look like anything in the scheme of things, right? Here's that October 2020 dip that we were talking about. If we look at RSI, even though it was indicating that it was oversold on a 180-day basis, on a 3-year basis, I mean, we have been as overbought from a RSI perspective as we've ever been, right? We've been hovering from April of this year, beginning of April, in this overbought, this red area, meaning that something's kind of got to give. Fed is indicating that they might start tapering, reducing the asset purchases that theoretically have been inflating the market from the COVID base. But I do think we do see some sort of continued drop. But I guess we have a quick question in the chat. Not new to trading the wheel, but new here. A few questions on our methodologies and premium. Yeah, if you've got questions on those, feel free to just go. I think beginner questions is the channel in our Discord. That would be good for those. No such thing as stupid questions in that Discord. Everyone who is trading options, anyone who's trading period, started with the exact same amount of knowledge, and that is 0 knowledge. So we have all been in the same place sometime. Your question is probably something that I once had myself, that someone else in the chat had themselves, and we have several people that are super, super, super helpful, which is another great aspect to that community. So I guess to close the loop on this conversation, it just doesn't look like this is that big of a drop, right? I think this is more what I have in mind for a pullback. Even what we had back at the end of 2018, which is kind of one of the bigger pullbacks in recent memory outside of the COVID crash, there's a lot more damage to be done here. And this is a pullback that lasted from October to I think about Christmas. Yeah. Lasted till October to about Christmas of 2018. So just because we have 1 or 2 red candles back to back right here doesn't mean that the worst is over. You're all clear. Definitely remain cautious with that buying big power, because as big of a run up as we've seen, we can go to the 5 year even, where this run up that we have looks even more insane. But yeah, be very, very careful. If this little pullback right here did some serious damage to your account, that's probably a good sign that you need to reevaluate the amount of risk you're taking, the strikes you're selling, and the approach that you're taking. Because if things were getting bad right here, if we have a repeat of what we had here, then come year end, things are going to be looking very, very bad. And our biggest goal here is to conserve capital, live to trade tomorrow. We're not trying to knock anything out of the park and pull 100% gains every year, but we're trying to go for maybe 1-ish% a week and have these gains slowly compound over time to give ourselves the performance that we've seen right here, and using these option selling strategies to give us big enough cushions in the market so that when things do start to pull back, we could still keep increasing our year-to-date profits, which as it stands right now, we are at a 90% return year-to-date from every single trade that we have made and alerted. So I think we are, I don't want to speak too soon, but I think we might be hitting that goal of a triple-digit return on a percentage basis in 2021, but that remains to be seen. This is what we've got set up for the next week in the market. It looks like we had a quick question in the chat about, hold on, there was a specific position. Yeah, Hyper's in the Twitch chat saying CCXI, October 15th. Is it a buy? Or I guess a sell. CCXI. Oh my goodness. What is this? For starters, this is a crazy chart is what this is. You've got a drop off from 48 down to about 10, which is something that would tell me this is probably some sort of biotech, healthcare type. There you go, healthcare. Not surprised at all. This is a token healthcare chart. And in general, we do want to stay away from healthcare in the trades that we're making because of red candles like this, right? We know that with our HT wheel strategy over time, we can continually lower our cost basis on different trades. And I guess this is one good example, right? Where we got in at 27.1, went down 16%, and we were still able to, ooh, whoops, these got called away for 23.5 the other day, so I should probably update that. But one of these things where it dropped a ton on us and we were still able to pull out a profit, even though week after week after week, it took a little bit of time. We could always be dropping our cost basis. GHIV, awesome example, right? This was one where we identified there was great premium. We got into this back in, December of last year, and it was called away in June of this year. So it was a 6-month trade. All in all, the stock dropped 12.36%, but we were able to keep chipping away at that break-even price week after week after week after week, and the amount of premium that we were able to collect, was overwhelming, quite frankly, on a month-to-month basis, and we came out with an $11,000 profit, despite a bullish position on a stock that dropped double-digit percentages on us. We've got a rule to say an average down, and it's never a realized loss. Absolutely, I like to refer to our losses as delayed gains in this system. But, every now and then there is going to be one that you need to close out for a loss because the premium just wasn't there. Corsair was one that we, this is wrong because the formulas are messed up and this changed. But we did take a loss on Corsair, which, annoying to look at now because as we see, we would have broken even if we kept holding. But, sometimes it's smart to take a loss, take that capital, move on to a better trade. But I don't think there was anything else in there really. We do want to avoid this because, I guess, to further and close the point that I was just making, when you have a big drop like this, you can't keep managing your break-even price. I mean, look at the options here. There's definitely some insane premium. I'm thinking they probably have some sort of binary event coming up, but I would tend to stay away from something like this because it could run away from you quicker than you can catch it. And that is something we want to avoid. We want to conserve our capital, live to trade again the next day. Because if we're never losing, we are winning. And that is going to be our approach to the market. That's what we've got for the upcoming week. And we are at about an hour, so I'm probably going to cut this thing out. Not a ton to talk about right now. We can take a quick look at the scanner, and I think it's going to be a lot of the usual suspects, right? We get a load scanner. We go high ROR puts. And for those of you who want to load this scanner in as well, the link to download this and use this in Thinkorswim on your own is on our website under HG Premium as well. Hourglass-trader.com. There we go. We're going to try to sort these by ROR if it's going to cooperate. Perfect. Now, every now and then you're going to get some extraneous results here at the top, like VIX. This isn't really, there, it disappeared. GREE was one that had a split from SPRT, and it's an 11 contract option, so this really isn't accurate, but just got to be paying attention to make sure what you're looking at is a legitimate result, and that's what we're getting right here, right? And IRNT, not surprised to see that at the top of the list because that's had a huge jump up. But again, this is a former SPAC, so we know that those can go back below 10 quickly, so definitely not something that I would want to own a 27 basis on. So, these scanners, we say this every week, they're super helpful to start generating trade ideas from, but not everything on here is going to be a good trade. And we've got, Cash Money in the Twitch chat saying, are we going to talk about EVLO? We can talk about it really quickly. EVLO, here's what's happening here. A 7.5 strike put, you could basically sell for $250 a pop, meaning that, it pays out 1 to 2, right? So your max profit is $2,400, max loss is $5,000 if you sell 10 of these, right? If you don't want to have that much at risk, you could just look at it from a 1, in which case you have a 50% return on this thing, and it's a cash secured put, so your break-even price is about $5 a share. So it's not an all or nothing type thing. People like spreads because they can provide that 50% return. This has the risk profile of a spread in the sense that you can get that 50% return, but the upside here is the fact that if it does go against you, it's not max loss, your spread's over, it's done. You're just going to have stock at a $5 basis. So this is a very interesting one. It wouldn't be the worst thing in the world to do for fun, but we've got to stick to our strategy and stick to our principles that got us here. This is a healthcare stock. They have some psoriasis data that's coming out in the next couple weeks, so there's going to be a pretty big move on this one way or another. If you are looking for kind of a fun trade, you're trying to get some excitement in the portfolio, this one might not be too bad, but I cannot officially endorse this, right? We see that the expected move right here is $6.41. That is obnoxiously large for something that is trading at $8.34, meaning the implication here is that the downside potential risk is down to, $2 a share, which is not something that I would be terribly thrilled with. And maybe if you are worried about that downside risk, you could still sell the 5 strike puts for 85 apiece. I guess with margin, that's a little bit better of a ROC as opposed to the ROR on there. But, better break-even price. But, in the scheme of things, this is less than a 25% return, and your break-even price is going to be 420, whereas this is a 50% return, and your break-even price is going to be 5. So it's really not even that big of a trade-off on, as far as basis is concerned. But the difference in return is pretty big. So I would definitely do the 7.5 if you had to take a pick. But officially on the record, I'm not trading this one because this is not in line with what we're trying to do as we build our smart, profitable, and consistent trades to keep growing on the year. But we got another question about SPIR, and SPIR is one I was taking a look at the end of the day on Friday, but I didn't quite pull the trigger. All right, another quick question from Aroldis in the Twitch chat that we have the free trade of the week in the Discord server. How does that work? And the answer is if you go down here, HT trades, we post one free trade a week. That's where it's going to be. These are going to be all the channels you could see for everyone who joins our Discord server. And that's a really important point that I want to make about our Discord server. It's free to join, free to talk. You get one free trade a week, and it's free, most importantly, to learn the strategies that we're putting into play. I think my goal has always been for anyone who is committed to learning something like this and wants to improve and make some more smart investments, to have that education side completely free and have that support there. And that is what we have. The premium really is once you kind of get those fundamentals down and understand what we're doing, one of the best ways to learn and get a feel for it is by actual trading and, seeing the actual trades we make as we make them. Helps you get in our mindset, get the experience of putting some of these successful trades into play, and can get you going on your own. But as far as the free trades concerned, we posted in here at some point during the week. If you've got alerts on for this channel, you'll see that. But the last 3 trades we've given out have pulled some really nice profits, $950 of profit just from the free trades. So for those of you who've been following those would pay for a few years of HT Premium. Just saying, not just saying. But back to closing the loop on our discussion for the night. We've got a couple people talking. SPIR 1015. I'm gonna put this on the screen because I feel like this kind of gets away. It shows up on the screen for a second at a time. RFig123 in the Twitch chat asking about SPIR 1015 7.5 strike puts for 30 cents. I don't know. Let's take a look. Not too bad. I mean, ROR 3.81% margin help right here. And oh my goodness, we definitely get some help on the margin side of things. This is like a 1/8 margin requirement, making this a 25% ROC. That's not bad at all. But again, even objectively, even if you can't use that margin and you have to, sell fully cash secured, you're still going to get a 3.81% return. I got distracted right there because I think my internet started lagging for a second and I was having flashbacks to when we had just a miserable night of streaming when it dropped like 2 or 3 times. So I think we're back up and going. I think it's still smooth, but another useful tool here, and I'm planning on making a video. I think it's gonna be on my next video, using the market maker move right here. And what's great about this is TD Ameritrade Thinkorswim has some proprietary formula which tells you based on the market makers, those who are selling the options, how much they expect it to move. Whereas if you have implied volatility right here, this is the implied move based off that. So typically when you see this right here, it's because there's a decent discrepancy between what you see right here from implied volatility, which implies that between now and October 15th, it's going to move $5.50 a share. But the MMM, the market maker move, is telling you that it's probably only going to move about $3.75, meaning the actual move is going to be less than the implied move, meaning that options probably aren't going to be worth as much. So whenever you see a lower number here than here, there is a really nice opportunity, because this would imply that the downside of the potential range over the next month is going to be about $10 a share, meaning everything here and below is going to be safe. But just to be very safe, if you want to take a look at SPIR from a chart perspective, I mean, it's running back above 10. It's looking very, very strong. I don't hate the 7.5 strike put at all. However, the fact of the matter is, look at JOBY, look at RKLY. Similar types of setups. Now, admittedly, these things aren't at 13 a share. They're a little bit lower. But as far as where their break-even price is situated, you get a little bit better value here. So, I mean, we're getting 40 to 70 cents of premium, I think, on RKLY and like JOBY. So I think those might be better, but this doesn't take a ton of premium, or excuse me, a ton of collateral thanks to these relaxed buying power requirements. So, not a bad one to stick in the back of your portfolio, because I think this is still, again, 3.81% in a month. That's a good return. And if you multiply it by the amount of leverage you're getting, that's a fantastic return on capital. So I like the idea of jumping into one of those SPIR trades. Next one we're talking about here, I think that might be about it for the night. And we are over the 1 hour mark. Another one where I'm treading lightly headed into the week. I'm really excited for the next time. This might sound weird to say, but I can't wait for the next big pullback, because that is when our stream is going to be going wild with ideas heading into the week. Right now, we're keeping buying power light. We're evaluating things on a day-to-day basis in the market, and that is going to be where we leave you off tonight. Stay tuned in the Discord, because, we come in with this many trades, and you see how long the list gets come weekend on most weeks. So there's going to be a lot of activity, especially if the drop that we're seeing right here overnight, now down to 0.47% drop in the S&P 500 futures. But if that holds, we might have some decent entry opportunities, and we are going to alert those in the Discord live as we make them. So thank you, all of you who again have joined us on this Sunday night. Hopefully what we talked about was helpful, give the mindset behind a lot of the trades that we're in right now as we head into the week. And hopefully I can provide a little more context for those that I enter in new for this upcoming week in the Discord server. But, I hope this was helpful. And I'm going to sign off the way I always sign these things off, which you guys are probably tired of at this point, so feel free to tell me to shut up. But thanks for watching. This has been the Hourglass Trader, where as time passes, we make money. And I hope we'll see you guys again next week on our Sunday night stream, where hopefully all of us will have a little bit more money than when we do right now. Thanks for watching, and we will see you next